Okay, we are recording. Hi there, everybody. I am doing this recorded lecture since we're not meeting in person today to give you a little bit of practice with our flexible budget. So we discussed the flexible budget in chapter 4, and we've been practicing looking at the difference between variable cost, fixed cost, and mixed cost. And so now we're going to look at an example of a flexible budget. We're also going to get into budgeting more in chapter 7. But since we have been talking about variable cost versus fixed cost, I thought that this would be a good problem for us to practice to get an introduction to this flexible budget. So again, the purpose of the flexible budget is that we can prepare it for different levels of activity. So once we know what our actual level of activity is, we can have a flexible budget that matches that number of units. And so I am going to share my screen with you and get this Excel file pulled up. And then once we finish with this, I will post this Excel file into Brightspace as well, so you guys have access to it also. But again, you can see here we're getting practice with the flexible budget. And so what we need to do, kind of the first step with this flexible budget, is to determine which costs are variable, which costs are fixed. So again, we've been getting practice with that this week. And so now we're just going to plug it into the budget and look at it in relation to this flexible budget. So I want to just add one column here, and we'll see why once we get started on this. But the problem is telling us, okay, so up here at the top, Tempo Company's fixed budget, and that's what this is here, right? Our fixed budget, it's just prepared for one level of activity, and the level of activity is 7,000 units, right? So that's a fixed budget. A fixed budget is prepared, and it's also called a static budget, would be another word for it or another name for it. But it's prepared for one level of activity, right? So Tempo Company's fixed budget based on sales of 7,000 units for the first quarter of calendar year 2021 reveals the following. It says prepare flexible budgets that show variable costs per unit, fixed cost, and 3 different flexible budgets for sales volumes of 6,000, 7,000, and 8,000 units. So the first step is to determine and figure out which costs are fixed, which costs are variable. So we're just going to go right down the line. So sales, obviously not a cost, but sales do vary, right? So, selling, we've got a selling price per unit, and the more units we sell, the greater our sales would be, right? That's intuitive, I think, to us. And so we will need to break that down per unit, but right now we're just looking at, okay, what are our fixed costs? What are our variable costs? So looking here under the cost of goods sold section, direct materials. Okay, so we've talked about direct materials before. Direct materials are a variable cost, right? Because the more units we produce, the more direct materials we will need. So in class, we used, excuse me, in class, we use the example of a bicycle manufacturer, right? So traditionally, a bicycle has 2 wheels, right? So if we produce 100 bicycles, we will need 200 wheels, right? Or if we produce 400 bicycles, we will need 800 wheels, right? So direct materials are variable based on how many units, right? So remember, variable cost remain the same per unit, but go up or down overall depending on the level of activity, right? So direct materials, variable cost. Same thing with direct labor. The more units we produce, the more labor hours we need, right? So direct labor is a variable cost. It varies based on the level of activity. Same thing with production supplies. The more units we produce, the more production supplies we need. So production supplies are a variable cost. Plant manager salary, however, this is a fixed cost, right? So remember, plant manager salary, that's a fixed amount. You know, no matter if we produce 100 units or 200 units, the plant manager salary remains the same. Sales commissions, this is a variable cost. You know, again, the more units we sell, the more sales commissions we have to pay. So that's a variable cost. Packaging, again, a variable cost. The more units we produce, the more cost we'll have for packaging, right? And it makes sense. Advertising, this is a fixed cost. Okay, now we get down here to administrative expenses. Administrative salaries, fixed cost. Depreciation on office equipment, we're assuming it's the straight line method, it's a fixed cost. Insurance, again, fixed cost. Office rent, again, fixed cost, right? So we have now identified the variable cost versus the fixed cost. And so the next step is to break our variable costs down into a variable cost per unit, okay? So with direct materials, for example, okay, so direct materials are 280,000, and remember that's for 7,000 units. So if we want to break it down per unit, and I'm going to put that here. If we want to break it down per unit, let me just bold this. No, it doesn't like that here. Let's see. Okay, so if we want to break it down per unit, we can say equals 280,000 divided by 7,000 units. Because again, our direct material cost is 280,000, and that's for 7,000 units. So we want to make it per unit. We take our 280,000 divided by 7,000 units. That tells us our direct materials are $40 per unit. And in fact, let me put this up here because we also want to break down our selling price per unit. So we had sales of 2,800,000, and that was sales for 7,000 units. So again, we want to know what's our selling price per unit. We take our 2,800,000 divided by 7,000 units. We're selling each one of these for $400 each. Let me format these cells so it turns it into some dollars for us. Okay, so we've got a selling price per unit of 400. Again, that's our 2.8 million in sales divided by the 7,000 units we sold, right? Direct materials, we want to break those down per unit. That's our 280,000 in direct materials divided by the 7,000 units we sold. So same thing for direct labor. So direct labor costs were 490,000 divided by 7,000 units. Direct labor is $70 per unit, right? Same thing with production supplies. Production supplies are 175,000 divided by 7,000 units means our production supplies are 25 per unit. Fixed costs, we do not need to break down per unit, right? Remember, fixed costs by definition, fixed costs remain the same at any level of activity. So we do not need to break those down per unit. Sales commissions, however, we need to break down per unit. This is a variable cost. So Sales commissions were 140,000, and again, that was for 7,000 units. So sales commissions are 20 per unit. Packaging, again, variable cost. So we take our 154,000 divided by 7,000 units, and packaging is $22 per unit. Advertising, we do not need to break down per unit. Advertising is a fixed cost. And same thing here with all of our administrative expenses. They are fixed costs. We do not need to break them down per unit. So we have broken down our variable cost into a per unit form. And that's what we have to do to prepare this flexible budget. So, you know, either way that we wanted to do it, we could fill in the variable cost first and then the fixed cost. We could fill in the fixed cost, then the variable cost. It doesn't really matter, you know, which way we do it. But I'm just going to start at the top and work our way down. So, sales for 6,000 units. So again, we have 6,000 units times our selling price per unit. So sales for 6,000 units would be 2.4 million. And we can go ahead and fill that in. We already know, because they gave us the information on the fixed budget. Sales at 7,000 units. Again, we've got selling price of 400 times our 7,000 units, 2.8 million. And then at 8,000 units, again, we take our selling price per unit times the number of units, or vice versa. We know with multiplication, it doesn't matter which one we do first. We could put 8,000 times the 400, but 3.2 million in sales dollars at that level of activity, right? So we've just filled in our sales. Now our variable costs. So we need to list these here. So our first one is direct materials. Then we have direct labor. Then we have production supplies. Then we have packaging. And then we have sales commissions. Okay, so now we have them listed. We can go ahead and start filling in our numbers here. So direct materials at 6,000 units, we take our 6,000 units times the selling price per unit, or excuse me, the direct material cost per unit. So at that level of activity, direct materials would be 240,000. Again, we already know at 7,000 units, we saw that on our fixed budget, but now we're putting it into flexible budget format. So 7,000 units times our material cost per unit. And then at 8,000 units, 8,000 times our material cost per unit. And so we have our direct materials at the 3 different levels of activity. Now we want to do the same thing for direct labor. So 6,000 units times our direct labor cost per unit. 7,000 units times our direct labor cost per unit. And then finally 8,000 units times our direct labor cost per unit. All right, production supplies. Again, we broke down our production supplies. They're 25 per unit. So equals our 6,000 units times $25 per unit. They'd be 150,000 at 6,000 units. 7,000 units times our $25 per unit, 175,000 for 7,000 units. 8,000 units, again, we take our 8,000 times our production supply cost per unit. At that level of activity, production supplies would be 200,000. Packaging, so we calculated our, which I guess I actually put these in here backwards here. Let me put them in the order they're given to us. Packaging. Because it lists sales commissions first. So sales commissions, we broke down per unit. Again, sales commissions are 20 per unit, so equals 6,000 units times our sales commission cost per unit. So we would expect sales commissions to be 120,000 at that level of activity. 7,000 units, we already know sales commissions would be 140,000 at that level of activity. And then 8,000 units times our sales commission cost per unit. At that level, we would expect sales commissions to be 160,000. And then lastly, our last variable cost here, packaging. And so at 6,000 units times our packaging cost of 22, we would expect packaging to be 132,000 at that level of activity. 7,000 units times our packaging cost of 22 per unit. Packaging is 154,000 at 7,000 units. And then finally at 8,000 units times our packaging cost of 22 per unit, we would expect packaging to be 176,000 at that level of activity. So now we have all of our variable costs listed. We can total them up. So equals the sum, all of these together. So at 6,000 units, total variable cost are 1,062,000. At 7,000 units, total variable cost, 1,239,000. And then finally at 8,000 units, we add all of our variable costs together. Total variable cost, 1,416,000. So on this flexible budget, we need to take sales minus our total variable cost, and that gives us contribution margin. So contribution margin equals sales minus our total variable cost. So at 6,000 units, contribution margin, 1,338,000, right? At 7,000 units, again, we're taking our 2.8 million minus our total variable cost, gives us a contribution margin of 1,561,000. And then finally at 8,000 units, contribution margin equals our sales minus our total variable cost. Gives us a contribution margin of 1,784,000. Okay, so we're done with the variable cost section. Now we need to calculate our fixed cost. And so we have our fixed costs listed here. So our first one, plant, and I'm just going right in order, plant manager salary. Our next one is what? Advertising. Our next one here, admin salaries. Then we have depreciation. And we have insurance. And finally, we have rent. Okay, The nice thing about the fixed cost, again, by definition, fixed costs remain the same at any level of activity. So once we get these entered in here, then we can just copy and paste. Fixed costs remain the same at any level of activity. So plant manager salary, 65,000. Advertising, 125,000. Admin salaries, 85,000. Depreciation on office equipment, 35,000. Insurance, 20,000. And then finally, office rent, 36,000. So again, we can, and I'm not sure why these are not formatted to give us the dollar signs. So let me do that real quick, because you know those little things drive me crazy. So now we can just copy and paste. Because again, fixed costs remain the same at any level of activity. And let's delete these guys. So we haven't calculated that yet. And so now we need to add these up, right? So our total fixed cost equal the sum of all, what do we have? 6 fixed costs here, 366,000. And we copied and pasted it, so it should be the same everywhere, obviously. 366,000. All right. So income from operations now. So income from operations, we're taking our contribution margin minus our total fixed cost. So at 6,000 units, we expect income from operations to be 972,000. At 7,000 units, again, we're taking our contribution margin minus total fixed cost. And so we expect at that level of activity, income from operations to be 1,195,000. And then finally at 8,000 units, again, we're taking our contribution margin minus our total fixed cost. And so we expect income from operations at this level of activity to be 1,418,000. So one thing I want to point out to you, you may have already noticed, this income from operation at 7,000 units, that was the same as the income from operations on our fixed budget, right? We just organized it differently. Here, this fixed budget is organized similar to the income statement, similar to the multi-step income statement, right? We take sales minus cost of goods sold equals gross profit. Gross profit minus operating expenses equals income from operations, right? So the fixed budget is organized like a multi-step income statement, whereas the flexible budget, we are, we're using the same numbers. As we can see, we came up with the same result at 7,000 units, but we're organizing it differently. We're separating the variable cost and the fixed cost. And we're preparing it not just for one level of activity, but for multiple levels of activity. So that's the benefit of the flexible budget. And we're going to see this formula more as we continue through our textbook. Essentially, when we set up this flexible budget, we use this format. We also use it for what is called the contribution margin income statement. Contribution margin income statement. This is not an income statement that we're preparing for external users. It's not prepared according to GAAP, for example, like we have to do for external users. This is something we prepare internally for our own cost accounting and managerial accounting decisions. So the contribution margin income statement is our sales minus our variable cost. That equals our contribution margin. And then contribution margin minus fixed cost equals our income from operations. Right? Just like we just saw on our flexible budget. And so, you know, this contribution margin, this is what we have left over after we pay our variable cost. The contribution margin is what we have left over to cover any fixed cost and to earn a profit, hopefully. And so that's the gist of the flexible budget. Again, we have to break down our variable cost into a variable cost per unit. Fixed costs remain the same at any level of activity. And then once we have our variable cost broken down per unit, then we can calculate what we would expect our cost and then income to be at any level of activity, just like we have just seen here. So hopefully that was helpful to you. When we come back on Monday, we will continue in chapter 4. There are a few more exercises or calculations that we want to do together related to overhead, calculating that predetermined overhead rate, for example, and then adjusting the factory overhead account when necessary. So there's a few more things we're going to do out of chapter 4. So we will spend a little bit more time on that together. As always, once you have a chance to view this recorded lecture, please let me know if you have any questions. Hi, guys. Okay. And I will see you guys soon. Bye-bye.